Good morning, dear friends and investors. It's a big pleasure and a big honor to all welcome you to our first ever webinar of Katch Investment Group. It's something that we're gonna do on a bi-weekly basis in the future. So we're gonna talk about markets, and also we're gonna talk about our investment strategies, views, and so on. So because it's the first webinar, I'm also taking the opportunity to give you a very brief introduction about our group. Some of you probably know Katch Investment Group is an investment and asset management boutique that is completely focusing on private debt. We have several investment vehicles up and running. We are basically created this company to respond to a very strong demand that we have seen from investors that were looking for non-correlated assets, low volatility assets with high income and high yields, and at the same time provide liquidity to investors, which is something pretty new and innovative. So we have been very successful in terms of fundraising so far, with currently more than 100 million assets under management in the whole group. Let me now start with a brief overview on the economy and on the markets. I think really we are very interesting times right now. It's somehow complicated to analyze the markets, but on the other hand, it's also pretty easy, because we can say that around 90% of market performance since mid last year, I would say, can really be contributed to two single factors. And factor number one, and clearly factor number one, is the China-US trade war that started around March 2018. It is something that has really affected the markets a lot since last year. And here we can see a small overview what has happened so far in the trade war. Just a very brief summary. So basically last year, it all started relatively smoothly without, let's say, a big impact, even though if we remember well, when we go back in time to March 2018, the news to get import tariffs of around 50 billion goods imported from China to the US was actually a very big news, right? But over time, I mean, the fight has really intensified, and right now we can see that we now have 25% tariffs on 200 billion goods, Chinese goods that are exported to the US. It's a bit a surprise that we are that severe right now, because if we remember well, last year there was a lot of hope for a trade deal, especially after the market started to correct around October, November last year, and we had the meeting between Donald Trump and Xi Jinping in Buenos Aires in November, if I'm not mistaken, last year. So there was really a trade truce, a deal, not a deal, but at least they were agreeing to work on a deal and to put the trade war on hold. And actually it was slow, but it looked very well, because until recently, specifically until mid-April, towards the end of April, it looked very good, and the deal was really in the making. Some analysts and some reporters were basically telling that the deal was 99% done in mid-April. This was probably also one of the main reasons why the market recovered that quickly from January to April, that we had very good months in terms of performance during this period. But then suddenly the opposite happened. We had no deal, and at the same time the tariffs were increased, and also there are a lot of threats to further increase tariffs on new goods from China to the US, also with measures taken by the Chinese to defend themselves. And at the same time, which is probably even more important, there is really an outbreak of a new war, probably a cold war in terms of technology between China and the US, which was best illustrated by the fact that the US made life very tough for the Chinese company Huawei, which is the global leader in 5G technology, which basically shows that there is a lot of mistrust, fears of espionage, and there is basically a lot of mistrust that eventually the Chinese could spy on the US in terms of communication and other technologies. So the consequence was basically that in May we had a very sharp market correction, and the biggest fear is right now that the trade war could basically end into a recession towards the end of this year or maybe in 2020. If we look at different reports and different analytics, it's also something that I have summarized on this slide. We can really see that the impact it is pretty big. So if we just take the measures that are in place right now, the impact on US GDP would be around 0.2%. The impact of Chinese GDP would be 0.4%, and on global GDP would be 0.2%. But probably if new measures are taken, the impact could more than double on GDP. And the worst year is estimated to be in 2021, because there's always a delay when there is new political measures. So the risk to get into a recession somewhere in 2020 is actually pretty high, given the fact that economic growth is very slow at the moment. Not particularly in the US, but in the rest of the world, we are very close to recession or close to no growth. So any disruption can basically push the world economy into recession. And this analysis basically doesn't even include some of the second and third derivatives of a trade war, which basically means that obviously there can be a very negative impact on consumer confidence, which means the markets can fall, on investor confidence, which means that the market can fall, on consumer confidence, which basically means that there is less spending, less retail sales, and finally also on the confidence of the corporate sector, which basically means that companies stop investing in capex particularly, and this is something that we are already seeing. So capex intention have decreased sharply in May. It's also a reason, it's also obviously a natural reaction, because today, after many, many years of globalization that basically had a very, very big impact on the global economy since 2003 when China joined the WTO. Right now, we can see that the world is very interconnected, that the supply chains, they are completely interconnected. So you have, for example, you have chip manufacturers like Qualcomm or Nvidia or Micron that do chips that then they get into the Chinese iPhones or Chinese phones like Huawei, etc. And the same is true basically for all industries. So iPhones are made in China, then back sold in the US and the rest of the world, designed by the US, chips made in the US, but then finished in China. So it's very challenging to have an uncertain environment where you don't really know what the rules of the game are going to be in the next couple of months. Where do I have to pay tariffs and so on? And this basically means that at the moment, companies just don't invest. If they have intentions to build up new production facilities or to set up new deals or new acquisitions, right now it's just not enough visibility there to do that. And this has already a real impact on economic growth around the world, obviously. So what's going to happen in the future? It's to be seen. My personal opinion is that first of all, this year it's going to be tough still. There is a very important meeting that we're going to have in Osaka towards the end of the month in Japan, where hopefully we're going to have some trade talks again between China and the US, and eventually there's going to be some relief in terms of at least conversations start again. But still, the risk is really there that any deal can be made, but in the future can be challenged again. And this can also be a bit illustrated on something that happened just last week, with the new tariffs imposed by Trump towards Mexico, the 5% tariffs. Actually, just this night, or last night, we knew the fact that they didn't agree. So there is still a 5% tax that is coming on June 10th. And the idea is that these tariffs are going to increase by 5% every month to reach 25%. So if there is not really a talk between Mexico and the US, the risk is very high that we have some disruption again. Probably it's not going to happen, but it shows a bit that there was a deal like the new NAFTA deal that was made last year, and now it's challenged again. So even a trade deal between China and the US in the future, at some point, it's going to be challenged, and especially the fight for dominance in the tech world. It's probably still going to cause a lot of disruption in the next couple of years. But the hope is really here that Trump is interesting to have, a reacceleration economic growth towards the end of the year, maybe next year, in order to start his re-election campaign. So this should lead to some relief sometimes in the markets, which is probably then going to be a good opportunity for investors to take some profits in equities, because the longer-term outlook is not necessarily very, very positive. Just a very interesting quote that I think illustrates a bit the way the US president thinks, and it's obviously nothing new. That's also what we have been discussing with the investors many times. So every time something happens, like in April, or like the Mexico tariffs that were just announced afterwards, people are surprised and the markets collapse. But actually, it's not a surprise, because what Trump is doing is actually what he's supposed to do, and what he was telling the whole world in his book, The Art of the Deal, that was published in '87. So a long time ago, more than 30 years ago. But it's still completely valid, and it's absolutely his tactics right now in terms of negotiation. So what he said is basically, in most cases, I'm very easy to get along. I'm very good to people who are good to me. But when people treat me badly or unfairly or try to take advantage of me, my general attitude all my life has been to fight back very hard. This is like the fight back mentality. And that's also what escalates a bit the trade conflict between the US and China, because we don't really know the details, but according to press reports, the Chinese wanted to change some small things in the deal details, in the contracts, last minute, which Trump obviously didn't like at all. And he felt offended and betrayed, and that's why he pushed back very, very hard, and that's why we have this new escalation in trade. So it's can happen anytime in the future as well. So probably markets are gonna stay very volatile. What we saw in May is obviously the markets corrected sharply, and at the same time we had a very, very big appetite for safe havens from investors. US Treasury yields, for the 10-year yields, they reached 2.07% last week, which is the lowest level since 2017. So it's really a clear sign that quality and safety is what our investors are looking for right now. Actually, the decrease in treasury yields in May was the biggest decrease in yields since 2003. So it hasn't even happened anytime during or after the financial crisis. It was really a very, very special month where we had risk on in April, or January to April, and risk off in May. So it's very, very volatile right now. And it's very likely that the volatility is gonna stay high. What the second factor, besides the trade war, that really has a big impact on the markets is monetary policy. Monetary policy is probably the second most important factor that has pushed markets higher from January to April. Because if we remember, back in September 2018, the Fed was still thinking of raising interest rates between 2 and 3 times in 2019. The markets were still implying a very high probability to have at least one rate hike during 2019, 1 or 2 rate hikes during the whole year. But these expectations have dropped significantly. And this is not just because the market wants rates to go down. It's really also because many policymakers have shown much more will, much more openness to reduce rates if it's necessary and if the trade war escalates. Last week, for example, Jay Powell, the chairman, said, "We will act appropriately to sustain the expansion," which basically is a bit a new speech, because they're really much more open to cut rates, and this has really helped to basically to push the markets up. And now probably it's also helping the market to eventually to find a rebound after the short correction in May. So a rebound could really happen if trade talks continue, and at the same time the Fed continues to show openness to cut rates. So we're going to have the Fed meeting on the 19th of June, so in more or less 2 weeks' time. And there we're going to see exactly what the expectations are. But right now, the futures, they are expecting 4 rate cuts, almost 4 rate cuts over the next 12 months. And if we look a bit on the details, the first cut is expected in July, where we have almost a 70% probability to have at least 1 cut in July. June is very low. June is only a very small probability. I think right now it's around 25% probability that we're going to see a rate cut in 2 weeks. So probably they're not going to cut, but if they don't want it to disappoint the markets that are very fragile right now, at least they have to be very open to do a rate cut in July or in September. And in fact, right now there is a 61% probability that at the end of 2019, the federal funds rate would be at between 1.5 and 1.75% or below, which thinks that the market is really pricing in 3 rate cuts by the end of the year: 1 in July, 1 in September, and 1 in December. It's going to be tricky whether this is really going to happen. These probabilities can obviously change if the markets rebound and if there is a more constructive news on the trade situation. But right now, it really looks like the monetary policy is going to be much easier than we thought last year. And it's probably also the reason why the market is not going to fall back to the December, to the Christmas lows that we had with below 2,400 in the S&P 500, for example. So probably not going to happen because the monetary policy has really changed. Just a very brief summary also on Latin America. Latin America is a region that we follow closely because we have several investments in Latin America. So it's always very important to analyze the economic outlook. And it's very surprising if we look at the economic performance over the last 10 years in Latin America. I mean, actually, Latin America was the region that had the sharpest contraction in 2015 and 2016, mainly driven by Brazil, which is a bit strange because we are supposed to be in economic recovery from the great financial crisis in 2008, and most economies have recovered over the last 10 years. But Latin America was basically, if you look at the average economic growth, it was almost 0. It was below 1%. So it's very, very disappointing if we look at the economic growth in Latin America. Obviously, there are some particular reasons like the collapse in Venezuela. GDP in Venezuela, I think, was cut in half over the last 5 years. So they lost half of the economic output in the last 5 years, which is a very particular situation, but still has an impact on the overall growth. Then in Brazil, we had, as I said, the big recession in 2015, 2016, which was mainly driven by the commodity collapse when the oil prices dropped below $30. And since then, we have had a very light recovery. There is some hope. Things have improved a little bit, but still there is a lot of, the growth is very low. And right now, in the first quarter of 2019, which is a bit of a shocker, the biggest 3 economies in Latin America, Brazil, Mexico, and Argentina, fell back into recession or contraction, at least for 1 quarter, which is a bit hard for the region. It was really a shock also for investors, not completely unexpected, but still it shows that Latin America as a region, given the low growth, maybe still the lack of economic reforms and some particular situation in some countries, is very fragile. And if we have an escalation of trade war, it's probably going to be a region that is affected. Now, there is still some hope because actually, if there is a solution in trade, Latin America can rebound. The starting point is very, very low, not only in terms of economics, also in terms of valuations, if we look at investments. And there is especially a lot of hope in Brazil. In Brazil, it's a country that has a big potential, has had very weak growth over the last years as well. But right now, the government is like a Trump-style government, but at least it's market-friendly. And the investor and corporate sector is pretty positive right now. But they need to do the pension reform, which is supposed to happen in the next 2 months. If this goes through, Brazil could actually be a very interesting place to invest, and it's something that we are looking at very, very closely right now. So just to finish the presentation, a quick overview on the most important economic events that we're going to see in the next couple of weeks. I already mentioned some things, so we're going to have the Fed meeting on the 19th of June, which is going to be very, very important. As I said, it's important to see the economic outlook, the dot plots, what the expectations are in terms of rates, growth, inflation, and so on. So it's going to be a very, very important event. We're going to have this Friday, which is tomorrow. Today's Thursday. So tomorrow, Friday, we're going to have the job report in the US. April was very strong. May, it's to be seen, because May, we know that the market contracted. So it's going to see whether we already see an impact on the job market. Probably it's not going to be severe, but the negative surprise could obviously be a risk for markets right now. Economists expect a growth in non-farm payrolls of 185,000, and to stay, the unemployment rate is expected to stay at 3.6%. So we'll see whether there is a positive or negative surprise this Friday. It's very important. Then in the Eurozone, we had actually today the BCE policy meeting. It wasn't a big surprise, so it was pretty dovish. Draghi mentioned that basically extended the period in which they do not expect to raise interest rates. Remember that in Europe, deposit rates at the European central banks are at minus 0.4%. So you don't earn money, you have to pay if you want to deposit money on the balance sheet of the ECB. And Draghi basically said that they're not going to only keep rates at this level by the end of this year, what he communicated previously, but they're going to keep the interest rates at current levels at least by the end of summer 2020. Summer, which basically means August 2020, September 2020. So most likely we're not going to see any rate hikes in Euro at all for a long period of time. And the monetary policy is going to stay very, very accommodative. They also continue with the new TLTRO program, which gives some cheap financing to banks to stimulate lending a little bit. And they reinvest the bonds that are maturing on the balance sheet. So the balance sheet is also going to stay pretty large. So it's good and bad. Bad is because they have been doing it for quite some time and growth hasn't picked up. But at least we know that the areas that are a bit leveraged are not going to suffer, because at least interest rates are going to stay at zero for a long period of time. Actually, in May, the 10-year Treasury, the 10-year yields on the Bund, the German sovereign bond, fell back to 0.2%, minus 0.2%, which basically means that you have to pay minus 0.2% per year if you want to buy a German Bund in euro for 10 years, which is obviously not very attractive for investors, but it's at least attractive for governments that have to finance their debts. So it's not a very sustainable situation, but right now the limbo in Europe is probably going to continue. And finally, we have some news in China next week to see whether China is seeing some impacts from the trade war. We're going to have fixed asset investment and industrial production. So we're going to watch this as well. And then most importantly, what I mentioned before is in Osaka on the 28th and 29th of June, we're going to have the G20 meeting. So G20 meetings usually are not very important events. But right now, given all these trade quarrels and trade disputes that we see, It's very important because probably Trump is going to meet President Xi, and if there is a conversation or willingness to open the dialogue again and to be a bit more constructive, this can certainly calm the markets and lead to a rebound in the markets. So in summary, in terms of asset views, what we basically see is, as I said, the situation is pretty tricky right now. We're going to have a lot of volatility in many asset classes. I'm not going to go into too much details right now, and we're going to publish a publication where you can see all these details. But basically what we say is equities are going to stay very volatile in a broad range. So plus minus 10% can happen anytime. It's not a very pleasant environment to invest. And we basically recommend investors that once we get a rebound because of rate cuts or because of trade advances, it's probably better to reduce the positions somehow. Right now we are neutral, but we might be a bit more cautious on equities in the future once we have opportunity to sell. And within equities, we really focus on quality names, and especially in the US. And we still have emerging markets, which is a bit a wild card, which is a bit aggressive call, because if there is a advance in trade, it's at least temporary, hopefully, given that we have elections in the US next year. So at some point, I hope there is political will to solve this. So there can be a substantial rebound, especially in Chinese equity that are very cheap right now. In fixed income, we don't really like risk. We like safety, but safety basically means that you don't earn a lot. We saw before that treasury yields in the US are at 2.1%, 10 years, so it's not attractive. In Europe, you have to pay if you want to invest in safe bonds over 10 years. In Japan as well. So you have a lot of negative yielding yields, but still it's something that gives you at least protection if there is a recession and a really bad environment. So right now we are neutral in sovereign yields, but we would probably increase that once the treasury yields they go to 2.3% or above. So we would buy more treasuries above 2.3%. And we don't like high yield or subordinated debt because it's just too risky to have this sort of exposure in the current stage of the economic cycle. On alternatives, it's really, I mean, if we look that we are not very positive on equities, of course, after a 10-year bull run and a lot of volatility right now with a limited upside potential, fixed income is completely unattractive because you don't get a lot of compensation if you take risk, and the safe bonds are basically yielding very, very little. So the real alternatives, it can obviously be found in the alternative space. In the alternative space, where we particularly like the private debt space, because we can see other segments like hedge funds have shown that they're not really a diversifier in certain times, like last year, when we had a very bad year for traditional asset classes, and at the same time, the hedge fund index dropped 7%. So didn't really help in a balanced portfolio. Real estate doesn't look very good right now because there is a big structural challenge because of technology, like the often quoted Amazon threat, that people, instead of going to shops or instead of using offices and so on, you do everything from home. You do everything online, which basically is very pleasant for the consumer. But for real estate, it's going to be a struggle, especially for shopping malls in the US that are having a very tough time, and there is an oversupply right now. And this can have a spillover effect also on other segments of the real estate market over time, because there can be a switch in the usage of different properties. So it's not very attractive to invest in real estate right now. Having said that, right now with the very low yields that we have in bonds, there might be some attraction, because at least you get an interesting yield for what you pay. The volatility is probably going to be too high in order to recommend real estate, especially liquid assets. I mean, there might be some niches that are interesting, but if you buy liquid real estate assets, the REITs, you get a lot of exposure to US shopping malls, European shopping malls, and so on, which is far too risky and far too volatile in our view for what you get. And this basically leaves us with private debt, which is a very new asset class. We're going to talk a lot about it in the next couple of webinars that we're going to have, which is really the area that we focus on most. We really believe that after the great financial crisis, there is a lack of financing for small and mid-sized enterprises. The banks, they don't lend money anymore to the smaller companies because of new regulations, because of higher compliance rules and so on. So for them, it's really not attractive, which basically opens the door for private investors to step in, to get very interesting deals, very strong collaterals at very high rates, because there is really a desperate need for many companies to get financing. So they are willing to give you a lot of guarantees and pay you a lot. And the volatility is very high. And within private debt, we particularly like the short-term area, because short-term enables us to give liquidity to investors. And it's also an area where banks are really exiting completely, because a bank is not really capable of doing a very quick analysis to take advantage of a short-term opportunity, because it's too bureaucratic and too expensive for a bank to do this sort of niche, smaller deals in the short term. That's where we currently see the most interesting risk-reward for investors. So with that, we conclude our first webinar. You have the opportunity to ask questions via the questions button. So if there are any questions, very happy to answer the questions. If not, most of you know us, so we're going to be available to discuss further details and also discuss our different strategies and views in much more detail. And I thank you very much for your attention and for joining our first webinar. And as I said, it will be a real pleasure to welcome you again for our next webinar. That's going to be in 2 or 3 weeks time. And we're going to speak specifically about our strategy that we are currently implementing in the private debt space. So thanks a lot for your attention, and goodbye.